मेरे पास पेटीएम है जो आईपीओ में लगे थे, so I
Uh,
11 shares for 1700, so I couldn't dare average करने का.
The IPO issue price of the Paytm stock was 2150 rupees, and today, 2 years later, it has crashed to levels of 650 rupees. That is more than 1 lakh crores of market capitalization gone. In fact, very few stocks have the capability of destroying investors' wealth like this one. Now, we are all familiar with the 2 golden rules of investing given to us by Mr. Warren Buffett. Rule number 1, never lose money. And rule number 2, never forget rule number 1. Now Berkshire Hathaway has actually broken these 2 rules and has sold Paytm while losing money. Now there could be many reasons behind selling a stock. Let's not get into assumptions. To really understand whether this crash is a buying opportunity or a potential trap, we need to have a look at the business. And we also need to find out what is the real reason behind this crash. So without wasting any time, let's get into it. Namaste and welcome to Retail Investing. So here is the chart. As you can see, the stock's all-time high was around 2000 rupees back in 2021. But after the IPO, the stock kept correcting for the next 1 year. But this October, the stock almost touched 1000. And here is the recent crash. It even hit lower circuits. And now the price is way below its 200-day moving average. So why did the crash happen? So in a recent analyst call, the Paytm management has said that they have decided to move away from the book now pay later loans and personal loans of under 50,000 rupees. Now these are unsecured loans, which means if you take these loans, you won't have to deposit anything as security. As you can see, the share of consumer loans in the postpaid category, also known as the book now pay later, was 78 to 81% 3 quarters ago. In the recent quarter, it has come down to 70 to 73%. Similar thing has been happening with the personal loan segment below 50,000 rupees. As of now, these small loans under 50,000 rupees make up the majority of Paytm's total loan portfolio. And from now, they have decided to shift their focus on bigger personal loans and merchant loans, which will be in the range of 3 lakh rupees to 7 lakh rupees. So why are they doing this? Well, according to the management, it's because they want to maintain the quality of their assets. A finance company's assets are its loans. However, there seems to be another major reason. The Reserve Bank has recently changed some rules regarding personal loans which are unsecured loans. Previously, if a lender like a bank or a non-banking financial company wanted to give a loan of 100 rupees, they had to set aside 8 rupees. This 8 rupees is a security against the risk of defaults. And now the lenders have to set aside 10 rupees for every 100 rupee loan. That's a massive increase of 25%. Now this move by the Reserve Bank is going to reduce the risk levels for banks and NBFCs, and simultaneously they will be forced to give out fewer loans. So here is some data. As you can see, the unsecured loans have grown very fast since 2018 at a CAGR of 26%. Such a fast growth in unsecured loans can create troubles for the NBFC sector in the future. The Reserve Bank wants to slow down this risky growth and reduce future risks for the sector. And there is another reason why the Reserve Bank did it, and that is to control inflation. You see, if people keep borrowing money and keep buying things, demand will continue to go up, and so will inflation. Now the market clearly did not like this policy change, and a lot of good stocks like SBI Cards have seen big corrections. But in the long run, this move by the Reserve Bank is actually going to reduce the risk for lenders like SBI Cards and also Paytm. Now in the lending sector, the rate of defaults in case of unsecured loans has already gone up quite a bit. But in case of Paytm, as you can see, the bounce rate for monthly installments has gone down compared to the previous quarter, which is a good sign. Now let's have a look at the financials. So here is the financial overview of the company. The market cap is roughly 41,000 crore rupees, but the peak market cap was almost 1.5 lakh crore rupees in 2021. All credit goes to the management and their Chinese VCs. The current market price of 650 rupees is quite close to the 52-week low of 472 rupees. In fact, from its 52-week low, the stock gained 111% to reach its 52-week high of 998. Now after the recent crash, the price to book value has improved a lot to 3.32. In case of finance stocks, the price to book value is a good metric for valuation. The return on capital employed and the return on equity are both in the negative. The cash reserves are very healthy at 12,347 crore rupees. So here is the profit and loss statement. As you can see, the sales have gone up 16 times since 2016, but the company is still not profitable. The operating profits are in the negative, but there has been steady improvements towards becoming positive. Here is the shareholding pattern. As on September 2023, the foreign institutions own 60.92% of the company. Domestic institutions hold a stake of 4.05%. Among the well-known mutual funds, only Mirai Asset is invested in Paytm. Public shareholding is very high at 35%. Now, Paytm is a professionally managed company and there are no identifiable promoters. So Paytm can claim to have the advantage of what is being called the network effect. The network effect is a quite straightforward concept. Take YouTube for example. As more and more users join the platform, the value of YouTube keeps going up. Paytm has been successful in getting more and more users join their platform even though they are not profitable yet. And this network effect can help them acquire consumers and merchants in a cost-effective way. If the cost of acquisition can be kept down and high monetization of products and services is done, the results are likely to be good. And the company also believes that they are building a strong brand. You see, a brand is the most powerful thing that any business can have. Now, as an user, if you feel that Paytm is a strong brand, please let me know in the comment section. So the main risk is credit risk or the risk of defaults that comes naturally from unsecured loans. But the Reserve Bank's policy change has reduced this risk to some extent. The second risk is regulatory risk. Any policy changes by the Reserve Bank is going to directly impact companies like Paytm. So is this crash an opportunity for retail investors? As of now, the business of Paytm does not seem to be in any real danger. But the way the stock has performed since its IPO, it does not inspire confidence in me. And that is just my opinion. Many professional analysts are bullish on Paytm. Motilal Oswal has given a target of more than 1,000 rupees based on the estimated earnings of financial year 2025. That's an upside of 53% from current levels. And I remember Mr. Ramdev Agarwal of Motilal Oswal saying in an interview that Paytm can grow at a CAGR of 40% over the next decade. A CAGR of 40% over a period of 10 years can transform an investment of 1 lakh rupees into almost 30 lakh rupees. But I am going to stay away from this stock mainly because there are many great opportunities in the finance sector. In fact, I made a video on some finance stocks and how we can find the next Bajaj Finance. I am going to link that video in the description, so please check that out. And don't forget to type in the comment section, what do you think of the Paytm stock? Especially if you are invested in it. And as always, this was just a stock discussion video and please do not consider it investment advice of any kind. If you got any clarity on Paytm's business, please like and share. And if you don't want to miss future videos, just click on subscribe. Thank you very much for joining and I'll see you in the next one. Jai Hind.